Hello and welcome back to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Jan Nevruzi and Giles Gale. All right, guys, I think when we agreed to take a 2-week break from Bondcast, we didn't quite realize how much was going to go on in the market. So we've got so much to catch up on, but let's start with the ECB and then Europe, because we're recording today, literally hot off the press. We've just finished watching the ECB press conference. So Giles, I'm really keen to get all your latest thoughts on what Lagarde said. So we got 75 basis point hike, as was expected, although I appreciate that this is kind of an as expected since we last recorded on Bondcast. So a lot has changed, but it was as expected as of a week or two ago. What else were the kind of key headlines there for markets?
Well, listen, I think the key headlines were that it was a hawkish delivery, as you would expect. I think that one of the things that stood out was the guidance that they expect to raise rates at the next several meetings. That was in the statement, so several. Talking about that a little bit in the Q&A afterwards, Madame Lagarde said that the path towards neutral was maybe another meeting, between another meeting and another 4 meetings. She actually talked about 2 or 5, but was including the one that she was actually speaking in. So, so I think, the midpoint of that, maybe we're done by December, and maybe we are done at some point early next year, at least in that sort of phase, returning rates to neutral. There was another question a little bit later on where she was really pressed on the point about whether they were on a path to neutral or whether they might consider going beyond that. And she didn't shy away from saying that if need be, they would raise rates to a restrictive stance. Okay, but of course, nothing about what that neutral rate actually might be. So I think at the moment, markets pricing in a sort of 220, 25, that sort of area as the peak in the policy rate. I would still say that that's a little bit on the low side if you consider sort of risk reward. Certainly they might stop below that, but I don't think we'll be talking about rate cuts next year, whereas we may well be talking about rate hikes. The other points, there was an overshoot still in inflation at the 2024 forecasting horizon, only downgraded from 2.4 to 2.3%. So, still, I would say a pretty significant message. And in their baseline for growth, they didn't project a recession next year. But that, and maybe just one last point, actually. I think it was interesting that she dismissed efforts to kind of tease her out about what might bring about a pivot in ECB policy. So, if we were to have a much sharper slowdown next year, would you cut rates? And it was just, no, let's focus on what's important at the moment. Let's not try and look round corners here. So, yeah, I think it was hawkish.
She's reluctant to tie her hands then. Okay, hawkish meeting. Now, the other thing that markets, I guess, aside from the obvious in terms of, the direction of travel of rates, the thing that markets been very focused on this week has been around government deposit remuneration at the ECB. Now, I feel like it's probably a little bit technical to go into the full details in this podcast, but can you just kind of give us a recap of what the story really is there and what we learned today? Because I feel like markets have been focused on that, but there's a lot of confusion around, let's say.
Yeah, I mean, it's an interesting one. And in a sense, it was actually more important than whether they went 75 or 50 today, because if they'd gone 50, I don't think it would have changed what people really think about the end point for policy rates in this cycle. So actually, it was really noticeable that until she made the point that there was going to be an announcement to follow the Q&A that would confirmed that they were going to raise the remuneration rate on government deposits, there was almost no reaction. And on that, there was a big reaction. And things like Schat spreads, for example, the spread between 2-year German and swap rates tightened quite dramatically as well on that. So, what is all that about in a nutshell? So I went through this in a lengthy note just this morning, actually. But the distillation, I think, is basically the way it's all about the way that reserves drain, and at the moment, most reserves drain at the deposit facility rate, and that kind of leads banks to kind of chase interest rates down towards that level. But quite a lot of reserves actually drain via the government sector because governments are running quite big cash balances at the moment. It's about 10% of excess liquidity, but that's about 500 billion euros. So, it's a lot of money. And the concern was that they have their remuneration on reserves that they park at their central bank capped or had that capped at 0, and that might push them to look for other sort of high quality cash alternatives rather than putting their money back to the ECB at that lower rate. And that might drive a squeeze for things like government bills, perhaps repo, and that might have a spillover into things like Shats and so on and so on. And as I say, because there's already quite a dislocation in that, between high and lower quality short rates, there was a concern in the market that would potentially significantly exacerbate it. But they addressed that, and we've had the correction. And I think that there will be things that will be on the table for us to discuss in future meetings around other measures they can use to address this more permanently.
How exciting. Lots to think about. Okay.
For money market nerds, there's nothing more exciting than this stuff.
I hope that everyone switched off the podcast during that. Hopefully they're still here. So perhaps we can go back to thinking a bit, sorry, I'm not trying to suggest that wasn't relevant or important, but going back to thinking big picture, because it has been a couple of weeks since we caught up on the pod. And like I said at the beginning, a lot has changed. We've had some big moves, in markets as a whole, but in fixed income markets. So perhaps you can put together with what we've learned about the ECB and the developments over the last couple of weeks to just give us an overall update of your kind of view on European fixed income.
Well, I mean, to be honest with you, it's pretty similar. We're still bearish. Now that is the key headline. I can't actually remember if it was before or after our last podcast. I increased our target on 10-year bunds to 2%. So, still a little bit of headroom there. I would describe our conviction as high. Why is that? Well, inflation is high and uncertain, as it has been all along. Interest rates are increasing quickly at the front end. We've got a bit of a theme, where this sort of dash for cash kind of theme, where essentially, this is an environment, inflation plus the interest rate reaction to it makes it a difficult environment for credit and equities, but also for duration risk. And as we move into the sort of the supply window into the end of the year, I think that all comes together as pretty clear set of bearish arguments at the moment. So I would describe our conviction as high on that, and not perhaps as high as yours, Imogen, on the UK. I'll come to that in a moment. When it comes to sovereign spreads, reasonably constructive, to be honest with you. But I think we'll leave that for another podcast.
All right. Well, let me take it off from Giles then, and just kind of switch to UK, where we've also had a couple of weeks now since we stopped recording Bondcast. A lot of action, and gilts have been the major underperforming over the period where we did since we've done our last episode. So what's been going on there? Why have gilts been so volatile and kind of leading the weakness in global fixed income?
Yeah, I'm a bit upset we've not been doing Bondcast because I've missed the opportunity to be able to gloat about our gilt forecasts. I think when we last spoke, we had just updated the 10-year gilt forecast to 3%. So it's nice to now be recording again, having reached that forecast, although of course I don't think we were really expecting when we set it just 3-ish weeks ago that we would have reached it already. I think a large part of what's been going on in the gilt market has until this week been front-end led. So we had a major repricing of kind of bank rate expectations, which is right because, you know, after the last MPC meeting, we felt like there'd been a big shift in the Bank of England's reaction function to caring much more about, you know, today's high inflation, spot inflation versus their medium-term outlook, and certainly versus their kind of more cautious growth outlook. And they had been leaning quite heavily on that more cautious growth side, I think, and the August meeting represented a departure from that. So the more that we saw, I guess, a rise in wholesale gas prices, and the more that influenced, you know, inflation expectations higher, it was right for the market to reassess where it felt like the Bank of England's rate was going. So that has been the, I guess, major development in the first instance that's led the latest leg higher in yields. And now much more recently, we've had, you know, increasing talks around the fiscal stimulus, and we're recording this on Thursday. So we've just had an announcement around what that means, and we can go on to talk about that in a minute. But with the kind of Conservative leadership election resulting in a Liz Truss government, and the narrative around what she was saying around how much support would be required to kind of mitigate the impact of these rising energy prices, the market had started to price in some degree of fiscal stimulus, and that's what's kind of driven markets, I guess, in the final stages to that 3% level, which is just about where we are in 10-year yields now.
All right, well, let's talk about that fiscal stimulus in question. There has been a lot of focus over the last few days on this emergency package that was announced by the Truss government. Does that matter? And can you give us a little bit of the details around it?
Yeah, so I guess the headline here is that, you know, as had been leaked quite widely in the press over the last couple of days, they have announced this energy price cap at 2,500. So that is an increase versus the April Ofgem price cap, where it was set at 1,971. But obviously is only part of the increase that we'd expected in October. You know, previously it was announced that there was going to be an 80% rise in October. So it's only a much smaller proportion of that. Yes, it matters. I mean, it matters in the very near term when it comes to our inflation forecast. You know, clearly that brings kind of down the peak and also brings forward the peak in our inflation profile, given that we don't have as much of this October rise as we expected, and then also won't get the additional January rise that we had baked in. So in terms of, I guess, near-term policy for the Bank of England, it probably reduces the need for outsized hikes. So it doesn't change our call for next week's meeting, where we think that they will just do 50. And I don't think this adds any kind of impetus to them doing 75, given that it does matter for, you know, very near-term inflation forecasts. But obviously, to the extent that this actually, you know, supports growth versus your previous baseline over the kind of medium term, I think that creates a little bit more of a hawkish outlook for the Bank of England. So we have upgraded our rates forecast to now expect, well, 50 at next week's meeting, as we originally had penciled in, 50 in November, which was in line with our base case before this announcement. Now an additional 50 in December, and then additional 25 basis points in February as well. So that takes your bank rate to 3.5 by Q1, by the end of Q1 next year. So essentially an additional 50 basis points of tightening that we've added into our forecast, just given how we think this fiscal support kind of changes the medium-term outlook really for growth and inflation. You know, it's sizable and it's broad-based, and I think that should matter for the Bank of England. Now, of course, the flip side of this is that this has to be funded somehow. And that's what I think is really important for markets, and actually a little bit where that's being mispriced in markets at the moment. This is most likely to come mostly via gilt issuance. Early estimates of how this is going to cost, of how much this is going to cost, is about 150 billion for the next 2 years. That's a huge increase in gilt issuance over the next couple of years. That's COVID style stimulus numbers that we're talking about here. But unlike COVID, we don't have the kind of offsetting easy monetary policy that will mop up a lot of that supply. So the net supply picture in the UK is about to change quite drastically, we think. Our early estimates have put about a sort of 40 billion increase on gilt supply in this fiscal year. But next fiscal year, that could get close to 300 billion in terms of gross gilts, we think, that are going to be issued to the market. And of course, you have then on top of that, the Bank of England doing quantitative tightening, we think, over the next couple of weeks. So not only do you not have the Bank of England taking out that supply as they did during COVID, but you actually are most likely to have them adding back into that supply and kind of making the problem worse almost for gilt markets. So there's a regime shift on the supply side, we think, that's coming. There's a regime shift on the monetary policy side in that, active sales and quantitative tightening are beginning. And I think there's a regime shift taking place on the demand side as well. Just as Giles talked about in terms of this demand for duration, not really existing. And that's true in the UK as well, and perhaps even more so in the UK, because I think that, the demand from a foreign investor's perspective, it isn't there. And it's not clear that LDI are going to kind of step in and their demand's going to keep pace with this increase in supply. So I think there's a big underestimation going on in the gilt market at the moment about how much this supply is going to matter over the next couple of years.
So how does that all those regime shifts, how do they tie into your gilt forecast?
Oh, well, I'm so glad you asked. So we have just updated our gilt forecast, hot off the press. Anyone that receives our research for our agile markets will know that we've just updated our 10-year gilt forecast to 4%. So pretty much 100 basis points higher than we are now, and obviously 100 basis points higher than what our previous forecast was just a couple of weeks ago. But that kind of takes into account this major news on the fiscal front, which is really the main driver of this change in view, but also what that means for bank rate. We think a higher bank rate at the front end of the curve should matter for longer end rates as well. A slightly revised inflation and growth profile, and also just a slightly revised ECB rate profile as well that kind of feeds into our fair value model for gilt. So 4% is the headline number, and that's our new target. So with that, probably enough on the UK. I think I rambled on long enough there. Let's switch gears to the US. It's been a very busy day today, but Powell has also just finished speaking. What were the kind of key takeaways for markets for what he said, Jan?
Yeah, he just ended up being coincidentally at the same time as Lagarde, so didn't, I guess, get all that much attention as it usually would have globally, but I guess the spirit of whatever it takes lives on with the Fed. I mean, he didn't. Let me start with the thing that he didn't really give too much about the September meeting. He didn't comment on a specific course of action, which is more or less what we expected, right? They're in a situation, the Fed are in a situation where they have to remain data dependent. That is the message that they've been sending the markets, and they're probably, alongside inflation, the number one battle right now is to maintain their credibility, because if they keep promising things that they have to stray away from, then that inevitably chips away from how the markets see how credible they think the Federal Reserve is. So the discussion was really around the Fed's mandate, the dual mandate, a lot about Fed's independence. He touched upon a little bit about fiscal policy, how fiscal policy has to moderate a little bit, and it's not really on a sustainable path. But he, of course, as tradition for Federal Reserve chair people, he didn't provide opinions on what the government should do. What he did say was that the Fed is committed to reducing inflation, that they're gonna keep fighting, aka keep tightening, as long as it takes until inflation comes back to target. not too much discussion on whether they're going to cut or raise interest rates next year. So far, the understanding is that the general consensus amongst the Federal Reserve is hike a lot this year and maintain rates next year as opposed to cut, which the market still doesn't fully agree with, although pricing for those cuts have moderated a lot. So generally, Powell leaving it on the data that's coming, and the specific set of the data that I'm talking about is next week's inflation number, which should kind of set the course for the September meeting and determine if it's a 50 basis point or a 75 basis point hike. Just to point out, markets are currently leaning more towards 75 basis point hike, and I think that's more or less like a binary bet on the course of inflation. And on the back of Powell's speech, the curve flattened a little bit more and the front end weakened.
Okay, let's talk about the data then, because I think that's obviously, their main focus, because we had last week the last jobs print that they will have before the meeting. And like you say, next week, the last CPI print. So let's focus on jobs for a second. I know it's a little bit backward looking, but it's obviously important for them and feeds into their discussion. What's your take on the number, and how much does that matter for them, do you think?
Yeah, of course, the jobs number did matter a decent amount. I wouldn't say as important as inflation, which we're about to get next week, but it mattered in the sense that we get a lot of data around average hourly earnings, which show a deceleration and imply that wage inflation is going to be a little bit less. We also saw an increase in the unemployment rate, which the Fed most likely welcomes, even though it has negative implications for the average consumer. It should help in theory with inflation. On the other hand, payrolls, the non-farm payrolls, implied that there were a lot more new jobs added this last month as well, which still shows that even though unemployment rate is ticking up, the job market is fairly robust, and it doesn't signal anything to imply the Fed has to kind of ease off a little bit or it requires like a dovish twist. Didn't change anything in my view. It just confirmed the message that leave it for inflation. Job market is okay. It's not really hurting, but it's also not really picking up steam. So pretty neutral picture there in my view. It just shows that data is not really falling off a cliff, which is in a sense good news because the Fed has already done a lot of tightening, but kind of passes the baton on to the next important key release, which is and their main objective, inflation.
Well, that leads us nicely onto inflation then. What are your expectations? And I guess the important question is, what kind of a number would you be looking for to change your view in either direction for 50 or 75, I suppose?
Yeah, I think, and that's really key for markets to gauge what they should price in for September as well. So we have a 0.3 in core, but that's what we would call a soft 0.3 because unrounded it comes down to 0.25%. It still shows a little bit more deceleration in important components such as the shelter part of inflation. However, at 0.25, we could, or like a 0.3 with a firm rental reading, we could see a scenario where the Fed decides to maintain 75 basis points. However, if say core inflation shows more weakness than we expect, kind of like 0.2-ish on a month-to-month basis, I think that could make the case. Well, as I said, like from the jobs section, from the jobs discussion, the average hourly earnings are coming down. You see a little bit more deceleration in inflation. Maybe it's time to dial it down a little bit because I guess we're now all used to being in an environment where central banks are hiking in massive increments, but 75 basis points months, like meeting in a row is a really high pace, and it generally implies that we might end, if they do 75 in September, that could imply that we're looking at kind of 3.75-4% federal funds rate by the end of the year, which is a significant amount of tightening considering that we just started hiking rates a couple of months earlier. So I would say it is hard to exactly point to what's the barrier for them to flip between 75 to 50, but since consensus has settled around 0.2, 0.3, I think the Fed will use that as a gauge and assume that anything below what the market is looking at is going to be supportive for inflation expectations, and they can allow to dial back as well and kind of take that into consideration. However, if we see any form of acceleration in inflation, that is really, really bad news, and that should shift the entire terminal rate profile significantly higher into next year.
I guess just to wrap up the discussion on the US, then probably a similar question to what I said to Giles, because I know since we last recorded, we've obviously kind of changed our call on what we think the likelihood of a recession is in the US, and also what that might mean for rates and for the shape of the curve. So do you just sort of quickly, I guess, give us an overview of where you are now on your rates view, given everything that we've just discussed?
Yeah, absolutely. Just as a background, since the last recording, we changed our forecast to now show a recession starting in Q4 this year, stretching into the first half of next year. Two main reasons for that. Real wages continue to go down. Inflation has been much more persistent than previously thought, which will erode consumer purchasing power and most likely lead to lower consumption. And on the other hand, we have CFO and CEO or general business confidence at very, very low levels, and they have been decreasing despite kind of like the recent bounce back in energy prices. However, which generally leads to lower capital and operating expenditures, and probably find its way through both business investment and eventually higher unemployment. So those are symptoms of a real recession, unlike what we saw earlier this year, where it was really driven by a lack of inventory rebuilding and a lot of imports. So with that, our call for Treasury, for the 10-year Treasury is really, I would say it is determined by a recession view, but for now, it is mostly a tactical view. Just this week, we went long again in the 10-year part of the curve because rates really went above close to their previous highs, especially in the 10-year when we got to the 3.3 range, which to us just kind of means that with a recession forecast in our outlook, it is hard to justify real rates continuing to increase like that, despite the Fed being aggressive, and especially if the Fed decides to dial up the hawkishness a little bit, that should lead to even flatter curves and lower longer-term yields.
Great, thank you. All right, let's round it out there this week. I know there was so much to talk about, and there likely will be next week. It feels like there's so much every week. But lots going on next week. We'll obviously have a more fuller market digestion of the ECB. We've got the Bank of England and US inflation. So lots to talk about. Thank you both for joining me, and thank you to our listeners. Just a reminder that if you liked today's episode, don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.